Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
Everyone, I am your host, Scott Henderson, and my co-host is Dr. J. We have been talking about some of the, well, let me just start over. The discussion that we're going to have today is something that is on Jason and my mind quite often. We have a lot of discussion, a lot of questions back and forth behind the scenes, and today we've got an expert coming on. So, Jason, who do we have coming on?
Scott, I am super excited to welcome David Stearns to the show today. Let me give you a little bit of background on him quickly. He's had a distinguished career in the military. His father was in the military. He is a retired lieutenant colonel from the United States Army. He actually flew helicopters and did some other pretty amazing things. He has 4 children and 9 grandkids. One specific thing I need to point out is that David Stearns in the late 70s met a girl that eventually became his wife. However, she was the daughter of none other than Nelson Nash, the author of the book Becoming Your Own Banker, which has, for both you and I, Scott, really been a huge factor. When I first read it, it changed everything I was thinking about financially. And so, David, welcome to the show.
Hey, thanks, Dr. J. I call you Jason, but I appreciate the invitation. So
that's okay. Call me Jason. That's just fun to go by that sometimes, which is a legal title. That's fine.
Like
so tell me, just real briefly, what it was like. Here's this man that's today known as the inventor, the creator, the discoverer, what you want to call of the infinite banking concept. And there's been so many people out there now. Almost 40 years later, after he first started preaching it, that have gone off on different directions: infinity banking, infinite banking, family banking, 7702. You can name 1,000 different things.
Yeah.
What was it like when you first went in and kind of said, "Hey, I want to marry your daughter"?
Well, that's probably the big problem. I never said, "Hey, I want to marry your daughter." It was like, "Hey, I'm marrying your daughter." It wasn't a question; it was a statement. So, and Nelson was a Southern gentleman, and he grew up in Athens, Georgia. He met his wife Mary in Athens, Georgia. He went to the University of Georgia, so he spent his entire life either in Georgia or North Carolina or Alabama. So he was a Southern guy, raised his family in the Southern tradition. And I didn't, I was an Army brat, like you suggested earlier, but my formative years were in New York. And in New York, you don't go through all those courtship rituals. At least I didn't. So basically, I proposed to Kim, and there's like, okay, we gotta tell my dad. And so it was like, okay. And so we lived in Hawaii. I was stationed in Hawaii, and Kim, her brother Barry, was in the same unit I was in, and he was a really good friend of mine. In fact, I sponsored him to the unit, and so I picked him up at the airport. So we were like, running buddies. And so he kept trying to get me to date his sister, who was flying over, in several months with her parents to spend. Nelson qualified for every equitable life trip on the planet because he was a top of the table guy, insurance producer. And so that year it was in Hawaii, in Honolulu. And so the story is, you got to meet my sister. You got to meet my sister. And it's just like alarm bells, ding, ding, ding. It's like, yeah, I've heard that before. But long story short is I resisted for a while. And the way I met her was she was over there for a couple of weeks with her parents on this trip. And Barry and I were overseas in Korea. And then we came back to Hawaii. And then he, linked up with his parents, and they spent a couple of weeks with them or whatever. And I kept resisting meeting his sister, Nelson's daughter. And so finally, she said, "Hey, can I stay here for a couple more weeks? With Barry, because he had a 2-bedroom place he lived in." And they said, "Sure, yeah, you got an open ticket going back so you can stay." Yeah. And so after they left, so I never met them when they were there. After they left, Barry says, "Hey, listen, we're going out to lunch. Why don't you join us? Blah, blah, blah." So I did. And so we started dating after that. So I met her and started dating her and proposed to her and never had talked to her parents, never had talked to Nelson. So it ended up being an uncomfortable situation, to say the least. Okay. Because, the more I think about it now, even, 30 or 40 years ago, the more I think, man, I was a real schmuck. I didn't handle that very well. So long story short is I met Nelson Nash 2 days before I married her daughter. Okay. And so we picked him up at the airport in Honolulu. He got off the airplane and we, shook hands, and I met his Kim's mom too. And the first thing Nelson told me was, "Boy, we got to talk." in his best Georgia accent, "Boy, we got to talk." It's like, yikes. And the wedding was like 2 days or something like that away from that time. So that was my first impressions of Nelson. And all I knew about the guy was that he was an insurance agent who had been doing it since the mid 60s. I think he started his insurance career in 1963 or 64 maybe. And so anyway, we hit it off, but he said, "Boy, we got to talk." Later on that day, I think it was, or maybe the next morning, I can't remember, but our first sit down conversation was him pulling out an application and basically saying, "Sign here." And so I said, "Absolutely." So I signed an insurance application for a policy. And that was my first experience with him. And that is that's way before any infinite banking concepts, any become your own banker. He was just a very successful insurance guy. And he'd been in the industry for, I don't know, 15 years. And he was a whole life advocate, big time, a mutual insurance company advocate, big time. And he was I don't want to categorize him as a libertarian, but he was a free market Austrian economist advocate. Okay, he was, and his mentor was Leonard A. Reed from Fee, and so he was all about freedom and individual contracts. Qualified plans are terrible. But it wasn't about infinite banking. It was about stuffing your money someplace outside the government grip. Okay. And the best place to do that, he thought, was these whole life policies. So anyway.
Okay, so we fast forward till the end of your career and you come to work with him. And of course, during that time, you worked a lot with him. In your words, let's summarize in 3 or 4 points what the infinite banking concept is.
That's a great question. I ask that question to everybody that I talk to too, and I get some really remarkable answers. But when I think about IBC, infinite banking concept, I think about it's a lifestyle. Okay. And, besides your religion, and I'm a pretty devout Christian, that's the basis of your life. Okay. And then on top of that, you got to control your finances, because that is the biggest stressor you have on top of your normal, daily interactions with people and whatnot. So IBC, the infinite banking concept, is a lifestyle. It's a plan. Okay, it's a yellow brick road that you can follow, where you can be free of banks, third party lenders. You don't have to rely upon qualified plans to retire, and try to strategize on how much to put in and how much tax deferment you're going to get, and when do you have access to those funds, and what your tax rate's going to look like when you finally do quote unquote retire. It's IBC's freedom. Okay. It gives you total control of all those financial buttons that everybody chases, and most people don't really understand what they're getting involved in. So it's not about policy design. It's not about which company to go with. It's not about this policy design is better than that policy design. It's about getting something that works for you, that you can afford, and that you can grow, and that provides you the freedom to use it from day one until you finally either retire permanently or offload your policy portfolios to the next generation. So
I remember Nelson would summarize the whole thing into two things. He would say, "Don't be afraid to pay high premiums and never steal the peace."
yeah, yeah.
And
Don't be afraid to
for those that,
capitalize.
yeah, those that are listening, you'll learn about that in the book, Becoming Your Own Banker, that's available on Amazon or infinitebanking.org, which is David's website now. So tell me, let's say we have a 20 something, early 30 something young couple, and they come to you and say, I want to learn more about this IBC. What would you say to them? What do they need to do?
Well, they need to read Becoming Your Own Banker. That's number one. If I was in production, if I was an insurance agent, I'd say something a little bit different than that. I would say, do you see an economic problem in your life? Okay, and the idea is that for that couple to understand what their cash flow looks like, and are they happy with it or not? And if they're not, then the solution is becoming your own banker, reading the book, because this is something that is not sold. Okay, and Nelson, you say this is more caught than taught, but there's so much noise out there in the mainstream media around the water fountain at work, on the golf course, about whatever where they're investing their money, what their rate of return is, all this stuff, but nobody really understands how to manage their cash flow and how to recapture interest and maintain control of their cash flow, which can be enormous over the course of their lifetime. And so if they don't understand that problem, then it's just a casual conversation. If they think something is wrong, then their first step is reading Becoming Your Own Banker and trying to understand where Nelson's coming from. Even if they don't get it, it's an initial exposure to them, because if you open up with whole life participating life insurance, it's like, oh man, that's bad stuff. So now you got to fight that demon. Okay, you say, here's Becoming Your Own Banker. What's that all about? So it's identify the problem, understand that there is a problem, and then offer them the first step, which is to take control of it by taking responsibility of actually doing their own research.
So let me expound on that question a little bit further. So let's say that they're a few steps down the line and they're opening up a policy. Who do they do it on first? Their parents, themselves, or the kids?
I'd say, whoever the working couple is, they insure themselves first. Okay, if both the husband and wife, if you're a married couple, they both work, then you get it on the major breadwinner first, because there is a death benefit that you have to worry about, and that is important. So, first of all, let me qualify that statement of saying I'm not a licensed life insurance agent, so don't sue me, okay? But I'm not. and I'll tell you why I'm not later on if you want to know about that. But I think it needs to be on the main breadwinner first of all, and then the secondary second of all, and then the children third of all. Okay, and then you load up as many people as you can within your family, because like Jason suggested, don't be afraid to capitalize is one of the precepts of IBC, because we're not talking about a bank like the big banks. We're talking about a privatized bank with a little b. We're talking about a whole life insurance policy, and there's only one way to capitalize an insurance policy, and that's premium. So the more premium you can pay, whether that be one policy or multiple policies, the more you're capitalizing these policies for use. And yes, you can only qualify for a certain amount of death benefit. Okay, so you know, but as your life moves along, that window keeps opening up and getting bigger and bigger and bigger as you're making more income, as you have more, if you're worth more, if you have more children that have insurable interest in, or if you have whatever, then you can always expand your system. Because another thing Nelson said was, this is not about one policy. This is about a system of policies. And he goes back and talks about banks having different branches and things like that, because you know this, Jason, that you can only get so much money in a policy, okay? And it only takes so much money in the form of premium, whether that be the base premium or a paid up additions rider, both scheduled or unscheduled or whatever. That's all you can get in there. And so as you expand your system, you have to explore what's the best strategy for the next policy that you're going to get. And so that's what we do. Myself, my wife, and then all our kids, and then all our grandkids. Because also, in the book Becoming Your Own Banker, Nelson talks about generational wealth, and he talks about grandparents insuring grandchildren, because the grandparents have probably more access to capital, disposable income, where the parents of the grandchildren probably don't. And so that's a good strategy. You load up the grandchildren, and the grandparents own those policies and pay the premiums. And then eventually those policies are transferred, either assigned, or the ownership transfer to either the parents of the kids, the parents of the grandchildren, or the grandchildren themselves. And so that's a good way to transfer that wealth from one generation to the next, or to the third generation, without even talking about death benefit. We're talking about actually transferring ownership of a viable policy that's been funded for 10, 15, 20, 30 years or whatever. Okay. So those types of strategies need to be laid out and thought about, because all those little relationships, they look different over the course of time, and how the policies are structured, the size of the policies, they're all can be determined by those relationships between the generations. And I don't know what it's like in Utah, but in some states, you can only get so much money on a grandchild, so much death benefit. Okay, it's restricted. Or it could be a floating number based upon how much insurance the parents own, or death benefit on the parents. So if you have the ability to load up a grandchild, it would be nice to know how much you can take it up to, right? And so that's why all those things need to be thought about. So anyway.
So why do you feel like the grandkids should be insured before insuring? Are you assuming that the grandparents are insured already?
I'm assuming the grandparents are insured. Okay. So, if the grandparents, they're 60 years old, okay, and they're both loaded up with multiple policies, okay, even if they're insurable, then they have policies established on their children, then instead of putting more insurance on their kids, it needs to go onto the grandchildren. Okay.
So let's be clear here. Let's take it from perspective of Scott, late 20s, early 30s. He's not the first generation that knows about IBC, but almost. He's grown up with it. I don't know how long the Nelson Nash Institute's been around, but I've been a member since day one, right? And I was doing IBC before then. And so he's grown up with it. And so this is a question that he has in mind, because he had a daughter born almost 11 months ago. And so he's asking me, do I insure my daughter or do I insure my in-laws?
Because they didn't know anything about it and they don't really have much insurance on them.
Okay, my question to you, Scott, are you going to own the policies on your in-laws, or are they going to own them?
I would.
Okay, again, you need to sit down and think of what that's going to do for you. Okay, because as the owner, then are you going to use that as a vehicle, financial vehicle for yourself, or are you just doing that and own it until they pass, and then now you have a windfall? Okay. Uh, you know, I'm not going to tell you what to do. Okay. But if every kid that we had, if they're insurable, okay, you put them through underwriting immediately. Because my first daughter, and Nelson wrote about her and becoming her own banker, was not insurable until she was 10 years old. Because when she was 5 weeks old, she was diagnosed with cancer. And so, I mean, if we would have put her through underwriting before that, you know, great. But so we always say, okay, grandchild, it goes through underwriting immediately. Within the first several months. That doesn't always happen because of different issues and what. Like my first grandson lived in England. He was born over there, so he didn't come back to the States until later. But the idea is to get them in underwriting and insured quickly, because you never know what's going to happen. Number one, and number two is, yeah, you can't get that much death benefit on a child, but if you put an L121 on a kid, that thing's going to be a pretty substantial policy when the child is 20, 30, 40 years old. Now, so again, I'm not going to tell you what's best, but that's just our philosophy.
Interesting. It has been a debate back and forth between us and talking about because there is the leverage and the leverage of time with in-laws and stuff. And I've told all my kids to say, hey, you in the event you go to get a job somewhere and you have a W-2, seriously think about not doing a 401k or anything, yet doing the same amount of money and buying a policy on me or your mother or your in-laws. That's where you store that type of money, right? You still have access to it, as you know, and it still can be a financing vehicle and really put you in control. I mean, again, what Nelson would say, don't be afraid to pay high amounts of premium, because you're going to get back every single dollar and then some on a guaranteed basis, right? There isn't a safer place on the planet to store cash.
Not only you store cash, but it's uninterrupted compounding. Okay. It's not taxable unless you do something crazy at the end, because you do have a cost basis you have to worry about. There's strategies for how to retire, quote unquote, passive income on these policies. It could be a form of accepting dividends instead of pay up additional insurance. It could be a form of policy loans. It could be partial surrenders. It could be anything to get that retirement funding, out of a policy into your pocket without paying any taxes on it. So it's like I said earlier about the lifestyle. You have the capability of using your imagination and figure out the best ways to do things for yourself without having to go through some government checklist. Okay. And not try to get in trouble with the IRS because you're not doing something that they want you to do, or you're restricted about when you can access your retirement funds from a 401k or IRA or whatever. And then you're still going to pay taxes on it, right? It's deferred. It's not free, but it's freedom is what it is. And like I said earlier.
And to put, say a little bit more what you said, go through a government checklist. The crazy thing being is that checklist can change at any time. Right? Oh no, hey, we changed that law. Now you're subject to this. That truly is not freedom. I mean, it's kind of a handcuff to an organization that you really don't know what's going to happen from year to year and from election to election. It's quite crazy. I want to talk a few minutes. Scott, do you have another question?
Go ahead.
I want to talk real quick, David, a little bit about the Nelson Nash Institute. I mean, it was originally the Infinite Banking Institute, and it changed the name to, I guess, to honor Nelson after he passed, the Nelson Nash Institute, which, from my perspective, being a member of that institute, is a coherent sort of ground rules, if you will, to help people stay true to this concept. How would you describe it?
Yeah, well, let me give you a little background on that too. We started the IBI, the Infinite Banking Institute, in 2013, and it just sounded weird. the Infinite Banking Institute. It sounded like a banking institute, which it wasn't. Okay. And so after about a year, one of our practitioners recommended that we change the name to the Nelson Nash Institute, because that was what we're trying to do. We're trying to preserve Nelson's legacy and his persona and how this thing works and why it works. So that's when we made the change. But the reason we created any type of institute at all was to house our training program for financial professionals. We first started way back in 2004. We used a couple of different insurance agents who were avid IBC practitioners with a small P, who Nelson routinely did seminars for, and they had internal agency training programs. And so we co-opt their training programs to help new agents go through a IBC type production training cycle, so they could understand how to implement these strategies in their businesses, their agencies, and they could understand, the policy design and handle policy loans with clients and this and that and this and that. Well, that didn't work out very well for us, because it ended up being, a personality contest. Okay, this agent was mad because that agent was doing the training, and a lot of these agents are Class A types, and to be a successful sales guy, you got to put yourself out there in front of everybody else. And so it just didn't work out. Plus, some insurance companies, some carriers, were starting to actually appreciate the production numbers that their agents were bringing in with the whole life production, and they knew they were kind of tied to the IBC strategy. And so these companies would contact us and say, listen, we still don't feel comfortable about this, because it's kind of like alternative financing, and it's not consistent with all the CLU training and whatever everybody goes through. And so we feel a lot more comfortable if you guys would develop a training program and kind of like let us validate that program. And so it didn't work with these agents that we kind of were co-opting with. And so luckily, Nelson was, good friends with Carlos Lara, and Carlos introduced us to Dr. Robert Murphy, who's an Austrian economist, and he did work in the financial sector for a few years. And so we came up jointly with an idea. Okay, if we create a training program, let's not make it an agency sales training platform. Let's do something that's more educational and more foundational, and it really teaches about the economics of life insurance. Teaches people about the kind of things that we're talking about now, about how do you really manage your cash flow? Okay, what does that look like in the big picture? Okay, if you talk about the Federal Reserve, you talk about fractional reserve banking. Okay, Austrians believe that that's the primary source of inflation, the increase in the money supply, and it's not just about printing money. It's about fractional reserve banking, where you can increase your digital accounts every time you issue a loan. It's digits, out of the computer, and they issue you a digital check or whatever. Well, that money didn't exist in that bank, so they've quote unquote increased the money supply. So we thought that all that was important also. So that's when we developed the program. We actually brought two insurance companies on board and used their legal departments and their actuaries to help us do this. And so that's where it started. And that's why we did it. And so the program was started in 2013, and we just housed it within the IBI Nelson Nash Institute. That was the start of it.
And today it's the gold standard, if you will. When you want, and I'm talking to the listeners here, when you want to have anything to do with becoming your own banker, or the infinite banking concept, infinity banking, whatever it is, you need to come back to the source. You need to come back to the unadulterated, pure, this is how it works, and understand the fundamentals, like you're saying, the economics and everything that's behind it. It's not simply, oh, hey, my policy's better than his. Hey, I can get you a little bit better here, or my company's this and that. It's really understanding how fundamentally whole life works.
Yep.
So kind of putting a fine point on that. And now pivoting a little bit, how do you handle the UL argument?
Well, I handle the URL. I handle it as saying that if you want to be an authorized IBC practitioner, you cannot sell a UL policy to a client who's interested in IBC and who wants a insurance policy to implement IBC in their life or business. You can't do it. You're restricted doing it because number one, they don't work the same. All they are is a term policy with a cash side account with an index. Number two is the risk has been shifted from the insurance company to the policyholder for UL products because I don't care what kind of guarantees you have, your premium is unknown. Okay, and so we say, I'm not saying an IBC correction. I'm not saying that a whole life policy is better than a universal life policy. I'm just saying you can't use it. You're restricted from using it. That's how we feel about it. Okay, and you can take that a little bit further if you want to about policy design within the whole life construct. We don't say, okay, you absolutely have to do this because it depends. Okay, it depends on the client. It depends on the client's knowledge about what they're doing. As long as the client understands what they think would be the best policy design for their specific situation, then have at it, as long as they're not being sold something because this number is bigger than that number. But UL policies, like I said, they're I don't own any. I own 26 policies, and they're all whole life. And I'd never buy a UL policy. So
You're being too kind. I'll say it. They don't work.
well,
They simply don't. I mean, you might be able to make it function for a few years and look good the first year, 5 years, whatever. However, when you understand the concept, the infinite banking concept, it is not only your lifetime. As you said, you have several policies, and you, with those policies, are affecting 4 generations. I mean, there are great grandchildren that have yet to be born in your family that stand to inherit a bunch of money. I have only one grandchild, and all of my grandchildren stand to inherit generational wealth simply for the fact that I have policies on all 6 of my kids. And that's going to pass to them income tax free. It's just simply, when you look at it, it's a bigger picture. It's that's just the way it is. I don't know how else to explain it other than say it and don't want to sound arrogant. I don't want to sound forceful. I invite you to study it and figure it out. That's just the way it is, period. I don't know. Would you say something different? Or even Scott, Scott gets hit up a lot from people he went to college with, or different says, hey, I'm a financial planner, let me help you out.
Yeah.
And he has some similar things. I don't know what you'd say, Scott.
For him, I don't understand them as well as you guys. I just know a little bit about building a team, and I've found who I feel comfortable with, and I trust your advice.
Wow. Okay. Trust Dad's advice.
It took 20 years, 29 years to get to that point, but here we are.
Yeah. In BYOB and plus Nelson seminar, he talks about, this is an exercise in imagination, right? Okay. Prophecy. Nelson was big on the human problem. Okay. And he thought that the human problem was much more important. And this is a multidimensional problem. Okay, we can talk about them specifically than any investment vehicle or any rate of return. Okay, and so that led to him saying, okay, if you can use some imagination and not just say, okay, this qualified plan is going to be great for me because I can write off all this, these taxes, every year. Well, use your imagination and take that tax savings, and if you translate that to more premium, what is that going to look like? But anyway, it's just too simple is the problem. It's not complex. It doesn't take some genius who's got some financial credentials a mile long to say, trust me, you don't get it because this is really complex stuff. But I'm qualified. Not your best interest is in my hands. It's simple. You can do it yourself as long as you understand the risks, you understand how to use it correctly, and you're responsible. You're a responsible banker. Because again, going back to the human problem, becoming your own banker is not about building a bank. It's about behaving like a banker behaves. Okay. Your behavior is important. Yes, you need a vehicle or a platform to implement these strategies, this banking process on it. And the platform is critically important. That platform's the whole life product. But your behavior as a banker is what is going to make it or break it for you. And that's a mindset. And that's getting on the other side of the table. Okay. And if you go to a bank, okay, they have, what's an asset on their asset list, in what's, their loan portfolios are assets. Okay. Not their savings accounts. And so if you own your own debt, then that's an asset for you as long as you're servicing it responsibly. So
anyway. I want to put a fine point on there, David. You have referred to the human problem, and that's a vernacular or term that you're very comfortable with, but our listeners don't know that. And what he's saying, everyone, is that the human problem is how you individually behave and the human tendencies we have. Today's the deadline for applying to college, and my daughter's at home pulling her hair out, getting it finished. That's just an example of everybody procrastinates and puts stuff off until the last minute. That's the way it happens, right? That is a human problem, a behavior that can stand in the way of you accumulating, enjoying, and even passing on lots of money, right? And there's other behaviors. And I'm with you, David. If someone had the right behavior and right habits and everything, they could be their own banker out of a mason jar on their kitchen table. There are principles that they would build wealth and do stuff and capture interest versus going to some, another entity or whatever. And from that jar to several other potential places to do it, if there could be hundreds, maybe thousands of examples. However, the absolute pinnacle and the absolute best, bar none, there's nothing so far away from second place is whole life insurance. That is simply what it is. And most people don't know that. Why don't more people know about this, David? The ultra wealthy do. And we've interviewed some fairly wealthy people on this podcast. We've had some people that are connected with big name families like the Hiltons, the DuPonts, some other generational wealth families. And they'll say it flat out. The wealthy use whole life like nothing else. Why do you think it is the general public doesn't know about this?
I don't want to sound like a conspiracy theorist. Okay. So I gotta tread lightly here, but it's because we created all these government qualified plans after ERISA back in the 80s, and Wall Street got together with their buddies at the Treasury Department, and they developed all these qualified plans to take care and protect the little guy. And so all that money that was sitting in whole life policies through the Depression and through World War II, people were told, no, that's a bad place to store your wealth. You need to have the government take care of it for you. And so we're going to create all these qualified plans for you, and we're going to give you these matches, and we're going to, save you on your taxes. And it's all the money is channeled into Wall Street, and who's making all that money on all that investment? Okay, it's not the 401k holder or the IRA holder. It's the It's the guys on Wall Street with their buddies in the federal government. And so that's what you hear. That's the stick. And then in the life insurance industry, didn't do themselves any favors at all. A.L. Williams, okay, Ralph Nader, all those names. When the insurance company basically got hammered in these congressional hearings because they were fleecing the public, and because you only got X death benefit with Y premium in a whole life policy, when you could have gotten a much larger death benefit with the same premium with a term policy, or a smaller premium with the same amount of death benefit. And oh, by the way, now you're saving all this money, so now you can squirrel it away in a qualified plan. So you're going to have the same death benefit, but you're going to have your money growing, protected by the government's qualified plans. It's a no-brainer, right? And the insurance industry did a poor job defending themselves. And on the contrary, what they ended up doing was creating all these creative policies, like the variable policies, the universal life policies, to quote unquote make them more transparent. And so they have more investment potential from the American public. And that's the same time when all these insurance companies were primarily mutual companies demutualized, so they could raise more capital. Okay, and so that was the beginning of the end right there. And so that's why I don't hear about it, because it's not part of the Super Bowl innovative commercial rollout every year, So anyway.
And when you're saying the hearings, right, and the discussion, even what you recounted there, the discussions about death benefit, where the discussion needs to be, and I think hopefully is coming through, the discussion here is about financing. It's how you finance the things that you acquire in your lifetime. And the insurance industry has failed, literally failed. I mean, they deserve the reputation they get. They have failed to describe the financing capability of a whole life insurance contract and what it can do for individuals, which that's really where it comes from, about being your own banker, being in control of your financial environment and not being beholden to a government agency, a bank, financing company, whatever it is, to tell you how you can have access to capital. Yeah. When you change that argument or change that discussion to a financing discussion, again, there's probably nothing that does any better. Well, yeah. All right. We're getting to the end, David. I could go on and talk to you, because this is just something I love to talk about. Scott, jump in a minute and tell us where we're at. Maybe give us some final and wrap this up for us. It's been awesome, David. I really appreciate your time.
Yeah,
I enjoyed
thank
it
you.
Also. We need to talk more about IBC. It might be something you're interested in. No, just kidding. No, yeah, you've been around for a long time, and I appreciate your support. And enjoyed being here with you guys. So
wonderful. Well, thank you again for jumping on with us, David. It's always a pleasure. Guys, if you'd like to connect with David, please check out the show notes down below. We will put links so that you can connect with the IBI or the Infinite Banking Institute.
Nelson Nash Institute.
Oh,
it was originally IBS. Now
it.
Nelson Nash Institute, right? And that's really, we should put a plug here. The concept's more important than an agent. The concept's more important than a company, or even policy design, like you said. However, I do recommend that in the event you're going to do this, find a authorized Nelson Nash Institute authorized practititioner. Sorry, Scott, to jump in there. Go ahead.
Which just so happens to be Jason. So if you want to talk about it, we'd love to have the conversation.
Yeah. We do list those practitioners on the website, so you can find them there. So
perfect. And if you'd like to talk to Jason or I, please check out the show notes down below. Hit us up on social media. All the links, again, will be down below. If you like the episode, give us a 5-star review and subscribe. We love to put these out every single week. And last, remember that mastering your millions all starts with your mind and your team. Make sure they are the best. We will catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.